Ladies and gentlemen, welcome back to another episode of this show. It doesn't have a name. It is the David Alexander Capital Management Yapping Fest, basically. By the end of the day, these kinds of videos, if you're here, it's because you're serious. You want to hear what I have to say. And, with these kinds of videos, my goal is not to sell anything. My goal is not to make it interesting to watch. My goal, I don't care really how many views it gets. It's really just to get my thoughts out there. And if you're somebody who's interested and really want to hear about this thesis or any other thesis I talk about, you're in the right place. But before we get started, we have a couple disclaimers. The following is not financial advice. I am not a financial advisor. I have no financial certificates. I have nothing like that. No Series 7, no CFP, no. I do not understand your financial situation, okay? And everybody has a different situation, which changes what makes sense for them. Investments in stocks are inherently risky. They can be extremely volatile. In certain cases, you can lose all your money. You can lose even your principal. This article and video, there's an article as well, but the video is just for entertainment purposes. Chegg, ticker CHGG, as of the time of this writing and recording, is a core position in David Alexander Capital Management LLC. We do not offer any services or products to the public. We do not take any money. We do not take any fees. We do not manage any stranger money, okay? So, no solicitation. Nothing like that. Lastly, I reserve the right to yap. Okay, this may be a long video. Like I said in the beginning, these kinds of videos are like, if you want to put this on while you're driving, or you want to listen to this in the background, because we're going to go deep. I'm not going to give you a 5-minute, oh, boom, 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 look at the chart, this, that. No. We're going deep because the case for Chegg is extremely interesting. It's a core position. It's the second largest position at DACM after Celsius. And it's really interesting. If you enjoyed the video, guys, subscribe, like the video, whatever, all that type of stuff. I don't post that often, but when I do, there's a good reason. It's because I think that this is very interesting. Without further ado, let's get into this. Okay? Chegg. You maybe have heard of it. You might have used it as a student. The moot point. Listen, yeah, if you look at a chart of this stock, it's down 99% from the very peak. AI destroyed this business. The thing is that one of the great things about this thesis and the position of it today is the fact that if you go on Twitter, if you go on social media and you look up Chegg, the majority of people are actually still talking about how AI destroyed the business. It's almost as if these guys, it's makes them feel good when they see a stock that went down 99%. Listen, that's not a good thing. People lost money. People lost a lot of money. And it's kind of like everybody wants to be a genius looking back with this whole ChatGPT thing. I'm not here to debate that. AI destroyed the business. That's why if you look at a chart, it used to be 115 and now it's $1.37. Okay? I'm not here to convince you otherwise. And that's not the thesis of this. The thesis, from a valuation, from an investment perspective, is that the bears have extended their stay, extended their welcome. And when we look at the sum of the parts of this company, there is, in my opinion, significant asymmetry in this stock as it stands today. And what do we mean by asymmetry? Asymmetry simply means that there are more levers that can go right for this business than things that could go wrong. And as somebody who's been in this stock and business for over a year and a half, I reserve the right to say that, because when I started investing in this a year and a half ago, it was a much smaller, more speculative part of my portfolio, simply because there were several uncertainties about the debt, about the restructuring of the business. Today, it's become a core position, not just like a 5%, a core position, because of the asymmetry that has revealed itself. And that's what we're going to talk about today. So, thank you for being here. Let's get started. Okay. I'm going to divide this into 7 levers. Okay? Usually, an investment is considered a good thing if you have one lever, okay, one thing that the business has going for it that provides an opportunity for outsized returns. Just one, okay? Chegg has 7, right? And we're going to go through each one. Number 1, the margin of safety provided by current valuations. Number 2, Busu and Chegg skilling in their growth. They're also referred to as the Chegg skilling, basically. Number 3, Chegg study is a melting ice cube, but produces significant cash flows. Number 4, the Google lawsuit. Number 5, the activist. Number 6, the data set. Number 7, the network. Okay, 7 levers. Let's go. Number 1, how today's valuation provides a significant margin of safety. So first, what is a margin of safety? A margin of safety is a term used primarily by value investors, popularized by, I believe, Benjamin Graham, but also, Seth Klarman, Warren Buffett. It's a very common value investing term. And value investors are simply people who try to find an asset where the current price of the asset has been severely disconnected from the inherent value. And the deeper that disconnect is, the higher margin of safety you have. Basically, you make money when you buy, not when you sell, because you bought it at a good price. And the bigger the margin of safety is at the price you bought it, the less you have to worry about. And so today, the business is worth about $150 million. If you want to buy the entire company, it's $150 million. Now, they have, in cash and cash equivalents, $68 million. Their only debt, which is convertible notes. A convertible note is a financial instrument. It's debt that can be converted to shares, and they're buying it back and paying it off because the shares have fallen so much. It's just like, nobody's going to do that. So 34, right? So net cash position of $34 million. So you're looking at an enterprise value of $116 million. An enterprise value is the market cap of the business plus the debt minus the cash, right? So $34 million in net cash, subtract that from the 150, you get to 116. And the reason why this is a great margin of safety is because there are several elements and parts inside of that you get for that 116 today. And I think it's worth a lot more than 116. This will only get better over time because, quote from Dan Rosenzweig, the CEO, in the latest earnings call, in the last 6 months, this team removed approximately 40% of our costs, put us on a path to zero debt, increase our free cash flow, and retooled the business to be AI first, giving us a strong foundation to grow from. Now, ignoring the rest, they're going to be at zero debt by the end of the year. Actually, most likely they'll be at zero debt by September, which I think we'll hear and see about that in quarter 3, quarter 4. So imagine now you have, let's say, $50 million of cash and no debt. The company's priced at $1.37, and there's a famous Peter Lynch quote that a company with no debt can't go bankrupt, right? So it's kind of like people. That's why when you see people, they say, "Oh, this is going to $0. It's going to get delisted." Well, is it really going to get delisted if they're going to have no debt? Margin of safety. Okay, that's number 1. Number 2, Chegg has a subsegment growing double digits. When we say growing double digits, we usually refer to revenue, and that is the case here. So if we remove ourselves from Chegg Study. Chegg Study was the homework platform. Let's be honest. I mean, people were using it to cheat on their homework, which is not a good thing. And they had a very well-known brand amongst high school students, college students. That is the business that got destroyed by AI because you can go to ChatGPT for free or Claude for free. It'll do the homework for you, which is, by the way, guys, it's not a good thing. But so basically, nobody's going to pay $20 a month for a homework help solution when you can just go to GPT for free. But inside of that package, inside of this company, are 2 separate offerings, Busu and Chegg Skilling. Together, they're referred to as Chegg Skilling, and they're a $72 million business. So that's kind of crazy, right? Remember, the enterprise value is $116 million, and inside of that is a $72 million run rate business which is growing double digit year over year. So that means that next year we should do closer to 80 million and then 88 million, and then you understand. Busu is a language learning offering for professionals. It differentiates itself from Duolingo because it's not consumer facing as much as it is business facing, meaning that large companies, particularly European enterprises, pay Busu in bulk, basically, to teach their staff English. So companies like L'Oreal, Puma, Unilever, Audi, they're very popular in this region: Germany, Austria, and Switzerland, German-speaking countries. But also L'Oreal is a French company, right? It's overall European enterprises, businesses who need their employees to speak English, and that's a growing business. B2B is growing double digits very, very well. I've used it myself as somebody who speaks four languages. I think it's a good product. I think you can really learn a language with it. It focuses on teaching you vocabulary that you will be actually using in conversation, whereas Duolingo is oftentimes more um, less focused, I guess you could say. It's more so like, you know, you can learn a lot of random vocabulary on Duolingo, where Boost is going to have you using phrases that are going to be immediately applicable to work. So that's Busu. Chegg Skills um, basically sells access to professional certificate boot camps and workforce upskilling programs. They have partnerships with companies like Wolf and Cornerstone. So Wolf is like an undergraduate degree type of thing, and so you can have the Chegg courses which count towards credit, and then Cornerstone is more so for employee training, and basically it's like certificates and upskilling, which has a lot of value, especially now as we're seeing kind of enterprises want to make sure that their employees know how to use ChatGPT and AI tools to basically train them and make sure that they are upskilled and know how to work with these tools to increase their productivity when they're at work. And Chegg sells, things like artificial intelligence for medical professionals, artificial intelligence for this, that, and the other. And so, yeah, so again, a $72 million run rate inside what we currently have. Chegg Study is an ice cube that is melting, but it still provides cash. And that cash goes into investing into the skilling business and other potential interesting business segments. So here we have two quotes from the earnings call. Dan Rosenzweig said that our investments in skilling are funded by the strong free cash flow being generated by Chegg Study. In other words, the cash flow that comes from Chegg Study goes into investing to make skilling better and bigger. He also mentions that Chegg Study retention remains strong, which means that even though AI has decimated traffic, of the people who are using Chegg Study, they aren't really canceling, which signals that we may be bleeding less and less and less. Now, I'm not saying this is going to turn around necessarily, but the longer it stays okay, the more cash we get to invest into the other parts of the business. David Longo, the CFO, talked about free cash flow. In the quarter, it was $3.1 million. But that included $12.9 million in severance payments because remember, they laid off I think 80% of their staff. So what does that mean? That means that if you didn't have those severance payments, you would have had $60 million in free cash flow on a $63 million revenue quarter, or a 25% free cash flow margin. And that is considered excellent for software companies because that means that 25 cents of every dollar that comes in is cash that you can then use to invest in the business, to buy back shares, things of that nature. Number 4, this is just kind of a nice to have. Google AI overviews destroyed traffic going to Chegg Study because basically if you search a problem into Google that usually would have taken you to Chegg, now AI overviews are there, and that basically means you don't go to Chegg, which kills traffic, and so they're in litigation for that. I'm pretty sure that the judge has ruled against Google in the past, so this could actually be a win for Chegg, but it's not the core thesis. It's just a nice to have. Let's say they have a settlement, they get millions of dollars. and we have to adjust the price based on that. Okay, and now we get into the meat and potatoes, because the real thing that made Chegg shift from being like it says here, a cheap long shot to an investment with actual catalysts occurred basically in like the span of 2 months. That's how fast things can change. And so the first thing I want to talk about is the activist. So we got an activist investor. His name is Bruce Galloway, and he mainly invests in beaten down enterprises that are trading at levels as if they were about to go bankrupt. And he looks at the ones that are actually like in a good position. Like, yes, just because Chegg is a penny stock and it is a micro cap, but I think that there's going to be, potential to make a sizable return from it. That doesn't mean that every single micro cap is going to be a 10 bagger, a 15 bagger, a 20 bagger. In fact, most of them will probably go bankrupt, right? But so what investors like Bruce Galloway do is they try to filter out the junk and they try to find what's actually good. And he has a good track record with a company, Regis, which I believe was working on, I think they owned like Great Clips, and he went in, helped with the restructuring, and he exited 300%, I believe. So he knows what he's doing. Basically, he's a smart investor, and he took a 5% stake in Chegg, and he cited that the business has an amazing brand. It's the strong scaling business I just showed you, the path to zero debt, meaningful cash flow that I just showed you, that it trades at only 0.5 times EBITDA, which is like ridiculous. You're trading at 0.5 times EBITDA. Basically means that if you invest in the company will generate your investment in earnings before interest, taxes, depreciation, amortization in 6 months. Okay. Most companies trade at like 10 times EBITDA, 13 times EBITDA. But look, the market is trading it as if it is a, deteriorating asset. It's left for dead. And the whole point of the thesis is to show why that might not be the case. And when that's not the case, well, let's just say there's a good thing on the horizon. His core thesis and what he wrote in the letter, his catalyst, so to speak, is that if you spin off the skilling business, that could be a great path to shareholder value. And what spinning off means in this context is there's this idea that when you have a business that has a lot of different parts within it, and you have one really good business and one really crappy business, but they're in the same company, basically, if you were to separate the company and have one stock that's trading just the good business and one stock just the bad business, it creates value because usually the good business will grow in the stock market because it's a healthy business. So earnings grow and it goes up in value, and it gives shareholders an opportunity. It really, what it does, it lets the market reprice the good business without the bad business. And so a good example of that is one of Bill Ackman's early activist investment plays was with Wendy's. And basically Wendy's was struggling, but they owned Tim Hortons, and they looked at the value like we're doing here with Chegg, and they saw that, Tim Hortons by itself would probably be worth more than all of Wendy's together, which includes Wendy's and Tim Hortons. So he took an activist stake, pressured the board, and they did that. And they made a lot of money because he was right. Tim Hortons went up a lot because it wasn't tethered by Wendy's struggling behind it. At the end of the day, even if this does not happen, it could happen, it could not happen, right? Even if it doesn't, like, we don't need it to happen. It would, maybe that's how we exit, and that's a great thing. Maybe not. The key is that by having an activist at a small company like Chegg, it really gives him leverage to be able to make sure that shareholders are represented as much as they can be. And that's not to say that the current board before Galloway was not representing shareholders as much as they could be. It simply means that after Galloway invested, it is more the case that shareholders are being represented. And the reason why that's good is because you have a voice, somebody at the table who has a lot more to make than me. And he's basically saying, like, you got to do this, you got to do that, you got to do that. And they're going back and forth. I'm sure they're exchanging ideas about how to make the most money, which is what we want. But this is really the meat and potatoes, okay? The activists changed the story from cheap long shot to, catalyst. This is kind of like when I saw this and I thought about it and I wrote this presentation before I got on the mic. This is when I was really like, have I just stumbled upon a gold mine? And, again, the disclaimer at the beginning, do your own research, not financial advice, not an advisor, but like I really sat back and was thinking about what I'm about to present here. And the reason why I put it at the end is so that you guys are now rewarded with this. But I was really like, is this a gold mine? Like, have we stumbled upon something like incredible? Okay, this headline came out May 13th, 2026, press release. Chegg expands into AI model training, leveraging a decade of learning expertise, subject matter experts, and proprietary data. Okay? On the surface, if you haven't been in Chegg for a while, it's like, oh, okay, whatever, move on. No. Like, we're going to get into this. We're going to get into this. Chegg study the homework help business, okay? They were doing that at a very high level, working. Like, that was a successful product for over a decade. We can say 12, 13 years. Okay. The way that Chegg study worked, basically, is Chegg had a network of experts in mathematics, physics, technology, and engineering. And students would submit problems that they were struggling with, and the experts would help solve it and publish it to Chegg. And they were basically working 24/7 on these problems. And so students would pay monthly subscriptions, or I guess their parents would pay, for the students who have access to this service where the student could see the answers. And it's like step by step, look, first we did this, then we did that, then we did that, boom, boom, boom. And so from that, Chegg really emerges with three key assets in this data realm. The first is you have a proprietary STEM data set. So I believe there's 180 million questions and answers. So questions from a student, answers from the expert. And most of those are STEM problems. And it's step by step, meaning it's a structured type of data, step-by-step reasoning solutions. This is very valuable for training AI models because historically LLMs struggle with concepts like advanced mathematics, physics, engineering, simply because LLM models, the core data type is a string, which is an array of characters. It's not a number. It doesn't have an understanding of logic, the way that humans do. An LLM simply predicts the next most likely token based on its training context and goes from there. So it's always been a struggle for LLMs to be really, really good at mathematics, STEM, but that's what Chegg has done for over a decade, right? And so 180 million question answer pairs, which is, by the way, a proprietary data set. You might think that's worth more than $116 million that you can buy the whole business for today, right? That's not a crazy thing to say. That's number one. Number two is the expert network. So they have around 70,000 experts. Just a lot of people. A lot of people that can solve problems. And we're going to talk about this because there's other companies like Scale AI, Surge AI. I know more about Scale AI, but Scale AI basically is a company that AI labs pay to have experts create problems, have step-by-step solutions, test models on those problems, and then it's called reinforcement learning with humans, because the human looks, okay, the model did this is a hallucination, this is a good answer to this calculus problem, this is not a good answer, it hallucinated that variable there. Because there's a human there, they're able to give the laboratory a really good training data set to train the model on, to make the model smarter. Okay, but that requires a network of experts to be able to solve those calculus problems, solve those physics problems. Well, guess who has a lot of experts? It's Chegg. They have 70,000 of them that worked on the homework. Some say they have even more than that, but that's what I saw on Google. Number three, operational infrastructure. So they know how to recruit experts, they know how to quality control, they know how to audit and performance manage, because they did that for over a decade with the Chegg study. So why is this pivot a big deal? Like, why is this one of those things where you look at it, you think about the numbers, and you're like, hold on, wait a minute, like this is a big deal. Well, they have the millions of step-by-step STEM solutions. They also have the experts. The quality control, the operational infrastructure translates very easily, okay? We already have early validation, so now it's getting interesting. Somebody's already paying for this at a very small level, and it's not a small company. They said in their press release they're in the Magnificent Seven. That means it must be either Apple, Microsoft, Google, Nvidia, Meta, Tesla, or Amazon. It's probably Meta because they're suing Google. Only Meta and Google are really, like, do they really have like a frontier lab? I might be wrong, but I'm pretty sure that's the case. Like, Google has DeepMind, Meta has the whole Llama lab. But, like, would Google really be paying Chegg while they're being sued? Maybe, but Meta is most likely the customer. We saw in quarter one that accounts receivable increased $2.2 million. And it literally says in there that that came from AI data licensing. So, but they didn't announce it. The weird thing is they didn't even announce it. Something tells me there's something cooking. Look, I don't want to, like, don't give me like a tinfoil hat, but something tells me that something is under the surface, because that's a big jump. That's a 14% jump in accounts receivables. The point is that somebody's already paying for this at a very small level. And the reason why the AI pivot is a big deal is because there's two ways they can make money from this. They can license the data to the labs, just give them the training data and say, here, like, here's whatever, 10 million physics problems. Train your model. Or, and this is really big, they could enter the AI training services business like Scale AI. And now let's talk about that, okay? How do AI training services work? Like, what even is that business, right? There are 8 key steps. This is the pipeline. The AI lab, let's say it's Meta. Meta is testing Llama. Let's say they're testing the model and they say, okay, Llama struggles with advanced math reasoning. It's struggling with, this type of calculus problem, whatever. Okay. They go out, they hire Chegg. Chegg goes to their experts who write different questions about different calculus questions. They write the solutions to those questions. They write explanations. They have a rubric. Then they have the model that Meta says is struggling with it, Llama 5, whatever the latest one is. The model tries to solve those problems. And then the experts manually look at the results. And they critique it. They say, okay, wow, that was a good response. That's really bad. That's a hallucination, etc., etc. They rank the responses like, oh, answer A was better than answer B because in answer A it understood the integral was like this, blah, 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 blah. Okay. And they take all that data, they package it into a box for training, and they send it to the lab, and the lab will use it to improve the model. Okay. What do you need for that business? You need experts. You need a good network of like creation and solving of problems. And you need relationships with the companies, the labs that are doing that. Okay. Well, Chegg has the experts. They've worked in problem solving before with the homework business. And they're in Santa Clara. They're a 20-minute drive from Meta headquarters. They're right next to Google. They're right next to OpenAI, Anthropic. They're in San Francisco. They're in the Silicon Valley. Okay? And we already know that one of the Max 7s is already paying for a pilot of this. Okay? So you tell me if you think it's a stretch to say that Chegg could actually do this business. It's clear that they can. And the reason why AI data training has demand is because as time goes on, and this is the macro thesis, the bottleneck is going to shift, and it already is, but it's going to shift more and more from hardware to software. Not hardware, but like hardware resources to data. Human evaluation reinforcement are essential. At the end of the day, we're at a point where the frontier labs, the ones that would be paying Chegg for this, they have a lot of money. It's like Anthropic, OpenAI, Amazon, whatever. Everybody has the GPUs. Everybody has the memory. Everybody has data centers. Okay, because again, not everybody, but the ones with money have it, right? Like Amazon can have it. Meta can afford it. Meta can afford the GPUs. Not everyone has good data for their model to use. Okay, the internet, which is basically what all the models get to train on because it's kind of like just out there, you can just scrape it. Is that legal or not? We're not going to talk about that. It's not good data though. The internet is not good data. And so Andrei Karpathy, famous computer scientist, very good guy. Like very, I don't know him. I don't know if he's a good guy, but he's like a very smart guy in the sense that his opinion matters on a topic like this. He was in a podcast. He said when you're looking at a pre-training data set in a frontier lab and you look at a random internet document, it's total garbage, right? Because people think that the internet is just like full of these Wall Street Journal articles with amazing, beautiful English grammar, the epitome of English journalism, amazing vocabulary, spectacular, understandings of different concepts. It's usually like a stock ticker and like poor grammar, and like the whole thing is a lie basically. So the demand for good data is going up, and that's where Chegg comes in, because Chegg has the good data and they have the network to create new data, because that's basically the same exact thing as the homework, at least for the STEM side of things. But that's the main thing you want to be in, is because STEM is where the models struggle, right? So let's think about Chegg and what it takes for a company like Scale AI to be in business. Expert networks, Chegg has it. Human feedback, they have it. Quality control, they have it. Data generation, they have it. Proprietary STEM data set, they have it. Actual revenue from AI? Not yet. Okay, not yet. And that's why the market hasn't realized this yet. But closer than we think, right? Because we just had a jump in accounts receivable, which came from some type of AI data licensing. Okay? So at the end of the day, you got to realize companies like Scale AI are worth billions of dollars, like over $15 billion, like 100x and up from where Chegg is today. Is where these guys, like, if Scale AI was a stock, I think it would be like a $150 stock, $200 stock, like in Chegg's equivalent shares outstanding. Today it trades at $1.37, so like over 100x. Chegg literally has all the ingredients to enter the business that they do today, but trades at less than 1% of the other valuation. They have the food that the LLMs need to get smarter. And the market doesn't see this yet, but the whole thesis, the whole idea is that eventually they won't be able to ignore it. Now, what can that actual catalyst look like from the perspective of a stock price going up? Well, something like Chegg Meta Platforms signed $20 million deal for AI training services. Chegg to license X data to Anthropic OpenAI for $50 million. When you get a headline like that, you go up. The problem is you won't be at $1.37 when that happens, because a deal like that basically changes the story. So look, what is your bear base bull case? The way I see it for Chegg. The bear case is that study bleeds and bleeds and bleeds. Scaling business doesn't hit the double-digit growth. Google lawsuit doesn't go their way. Activist, he leaves, he sells his stock, and nothing happens with the AI data set. Okay. It'll probably go to like 50 cents, and that sucks, right? The base case, because the management knows this. Like, the management is not a group of idiots, okay? The base case, in my view, at the very least, at this point, is that maybe they can't get the training services right, but they sure as hell can just license the data to labs, which is just like, that's like almost 100% profit. You just give them the data. You just give them the data. That is so easy. Like, literally, the, like, I don't want to use like a bad word, but like, a very not bright person could figure out that that's all you gotta do is just take the data, give it to the lab. Currently, they're licensing less than 5% of their library. So even just going to 100%, that could be like $50 million a year probably in revenue based on the current data we have, which is a lot more than, you know, that's a lot of money. And a company like that wouldn't be trading at these valuations like reasonably. Now, the bull case is the licensing of the data, the scaling business continues to grow, the study business keeps producing cash. Let me just tell you something. If Chegg turns the corner and enters AI training services, okay, meaning that they begin taking contracts from labs to use their expert network to train models, like, I don't think you guys realize what happens. Like, I don't like to talk in hyperbole, but literally, I don't think you realize what happens. It will literally be just like, I'll probably have tears because it would be just like the most beautiful thing, you know? Not like of all life, many things more beautiful than that, but I mean, like, purely like if you're in like a just thinking about stocks and stuff, it would just be so beautiful because the company would have gone literally through the trenches and come out on the other side. And the beautiful thing, and the reason why I'm so bullish, is because they have all the ingredients they need. They have, if they were making a cake, they have the eggs, the flour, the milk, the cream, the sugar, the salt. They have everything they need. They have the vanilla extract to start that business. And that's the type of business where you don't have that many competitors. You're probably going to have like 5 big players. And with Chegg's network, they can do it, right? And again, today Chegg is valued at $116 million enterprise value. Companies like Scale AI are valued at $30 billion and more, okay? And I'm not saying that they're going to go to that valuation, but I'm saying that even at a fraction of that valuation, there is major, major upside. So, like I said, I was going to yap, but if you're still here, man, leave a like, comment what you think, and I am very excited about this. It's either going to, I think it could really go my way. Maybe the market never sees it. In that case, you live and you learn. But it appears to be asymmetric enough that you just have to, in my opinion, hold on to the rope and see where it goes, because it feels like it's going to better places. Ladies and gentlemen, DACM. Thank you for watching. Bye-bye.